risk of global inflation uncertainty and recession in 2023. Global economic activity is experiencing a broad-based and sharper than expected slowdown, with inflation higher than seen in several decades. The cost of living crisis, tightening financial conditions in most regions, Russia's invasion of Ukraine, and the lingering COVID-19 pandemic all weigh heavily on the outlook. Global growth is forecast to slow from 6.0% in 2021 to 3.2% in 2022 and 2.7% in 2023. This is the weakest growth profile since 2001 except for the global financial crisis and the acute phase of the COVID. As central banks across the world simultaneously hike interest rates in response to inflation, the world may be edging toward a global recession in 2023 and a string of financial crises in emerging market and developing economies that would do them lasting harm. According to a comprehensive new study by the World Bank, central banks around the world have been raising interest rates this year with a degree of synchronicity not seen over the past 5 decades, a trend that is likely to continue well into next year, according to the report. Yet the currently expected trajectory of interest rate increases and other policy actions may not be sufficient to bring global inflation back down to levels seen before the pandemic. Investors expect central banks to raise international monetary policy rates to almost 4% through 2023, an increase of more than 2 percentage points over their 2021 average. The global economy's future health rests critically on the successful calibration of monetary policy, the course of the war in Ukraine, and the possibility of further pandemic-related supply-side disruptions. For example, in China, global growth is forecast to slow from 6.0% in 2021 to 3.2% in 2022 and 2.7% in 2023. This is the weakest growth profile since 2001 except for the global financial crisis and the acute phase of the COVID-19 pandemic, and reflects significant slowdowns for the largest economies, a U.S. GDP contraction in the first half of 2022, a euro area contraction in the second half of 2022, and prolonged COVID-19 outbreaks and lockdowns in China with a growing property sector crisis. About a third of the world economy faces 2 consecutive quarters of negative growth. Global inflation is forecast to rise from 4.7% in 2021 to 8.8% in 2022, but to decline to 6.5% in 2023 and to 4.1% by 2024. Upside inflation surprises have been most widespread among advanced economies, with greater variability in emerging markets and developing economies. Risks to the outlook remain unusually large, and to the downside, monetary policy could miscalculate the right stance to reduce inflation. Policy paths in the largest economies could continue to diverge, leading to further U.S. dollar appreciation and cross-border tensions. More energy and food price shocks might cause inflation to persist for longer. Global tightening and financing conditions could trigger widespread emerging market debt distress. Halting gas supplies by Russia could depress output in Europe. A resurgence of COVID-19 or new global health scares might further stun growth. A worsening of China's property sector crisis could spill over to the domestic banking sector and weigh heavily on the country's growth, with negative cross-border effects, and geopolitical fragmentation could impede trade and capital flows, further hindering climate policy cooperation. The balance of risks is tilted firmly to the downside, with about a 25% chance of 1 year ahead global growth falling below 2.0% in the 10th percentile of global growth outturned since 1970. Warding off these risks starts with monetary policy staying the course to restore price stability. As demonstrated in Chapter 2, front-loaded and aggressive monetary tightening is critical to avoid inflation to anchoring as a result of households and businesses basing their wage and price expectations on their recent inflation experience. Fiscal policy's priority is the protection of vulnerable groups through targeted near-term support to alleviate the burden of the cost of living crisis felt across the globe, but its overall stance should remain sufficiently tight to keep monetary policy on target. addressing growing government debt distress caused by lower growth and higher borrowing costs requires a meaningful improvement in debt resolution frameworks. With tightening financial conditions, macroprudential policies should remain on guard against systemic risks. Intensifying structural reforms to improve productivity and economic capacity would ease supply constraints and in doing so support monetary policy and fighting inflation. Policies to fast-track the green energy transition will yield long-term payoffs for energy security and the costs of ongoing climate change. For the coming 8 years will keep the macroeconomic costs manageable. And last, successful multilateral cooperation will prevent fragmentation that could reverse the gains in economic well-being from 30 years of economic integration. The U.S. has already experienced 2 consecutive quarters of negative GDP growth in 2022, which some people consider being a recession, but others are waiting for the National Bureau of Economic Research to make the final call, and it has yet to do so. Economic growth is slowing, but the economy continues to grow in the second half of 2022. There are some headwinds, such as tighter monetary policy and an impact on global energy and food markets as a result of the Russian invasion of Ukraine. Job growth is slowing, but demand for workers is strong. Inflation is high but not as high as last spring. Consumers are spending more in some areas but cutting back in others. Job openings are high but falling, while layoffs are low in, well, it depends on what indicator you watch. Inflation affects everyone, but not equally. Low-income families are impacted harder, Brown says, compared to higher-income families with more savings. The last quarter of 2022 and the first quarter of 2023 are likely to see negative real GDP growth rates, while recession probability hovered near zero after the initial phase of the global pandemic from September 2020 to March 2022. It rose to over 30% in April and reached 50% in May. According to NBER data, the average U.S. recession lasted about 17 months in the period from 1854 to 2020. In the post-World War II period, from 1945 to 2020, the average recession lasted about 10 months. To help prepare for a recession, job loss, or other financial hurdles, aim to build an emergency fund that covers 3 to 6 months of living expenses. If you're falling behind in debt payments, reach out to your creditors and ask for hardship concessions. Almost 90% of those surveyed expect growth in Europe to be either weak or very weak due to the war in Ukraine, high inflation, and threats to energy supplies and growth. Projections are expected to be worse next year across the continent. In 2022, weak or very weak growth in China is expected by 67% of those surveyed, with COVID-19 restrictions and concerns about its real estate sector weighing this down. However, more respondents expect its economy to pick up in 2023, with 66% anticipating moderate or strong growth, although almost 65% of those surveyed expect moderate growth or better in the U.S. in 2022. Optimistic projections drop to 37% when it comes to 2023. The likelihood of ongoing monetary tightening is considered to be a critical factor in this. 4 in 10 economists expect growth to be weak in Central Asia in 2023, twice as many as in 2022, while in Sub-Saharan Africa, 43% are predicting weak growth in 2022, with a much higher 60% of respondents predicting the same for 2023. However, the picture is looking less grim in other parts of the world. The report says 71% expect growth in the Middle East and North Africa region to be moderate or better. This is reflected in a strong year enjoyed by the region's energy exporters. In South Asia, the vast majority of economists expect moderate growth in both 2022 and 2023. More people expect moderate growth in Latin America next year than they do for the rest of 2022 to 56%. Here are some real-life interviews of people and their lives in current situations.
Hi, I'm John Gerald Parilla and I'm from the Philippines. So as you all know, our global economy is facing a lot of challenges from war, COVID, oil prices, and inflation. The US Fed raises interest rates to tame inflation, which caused the US dollar to spike at its price. And a lot of countries are affected, including my country, the Philippines. Our bonds, stocks, peso went down, and our annual inflation rate rose up to 6.4%, which is the highest recorded from near 4 years. And our oil prices went up, which affects our transportation services, and we are now experiencing fare hikes on our transportation, including the jeepneys. It went up to 33% spike from year to date, and our bus went up to 15% spike from year to date. Our TNBs went up to 13% from year to date. which costs us more as a Filipino. And we're spending a lot, or we're spending more on our transportation. And speaking of oil prices, most of fuel and transport dependent consumer goods like food are mostly impacted. And to add, our country's unemployment rate was reported at 6.4%, which is roughly 2.93 million Filipino or unemployed Filipino people. And I think our economy will take longer to recover. So, yeah, let's see.
Hi, it's Al from Bangladesh, and Bangladesh is a underdeveloping nation. There is major economic conditions in Bangladesh now is happening. Firstly, it's a overpopulated country, and there is not enough job sectors in Bangladesh. Recently, we have faced problems in our energy sectors like gas and electricity. We export garments items, and for the energy issue, we are having problems in those sectors. There is some another problems like distributing the resources among the people. We are facing problems about price stability. Structural things are growing. Let's see what happens.
Thanks for watching this video. If you find something helpful, please don't forget to share this video with your friends and families. Please like and subscribe and leave a comment about your country's current economic situation.